meeting is live now. Please start the meeting.
Good evening, everyone. Welcome to this different educational program from Kerala Society of Ophthalmic Surgeons. Of late, we have been conducting a lot of educational activities based on ophthalmology-related educational activities. And the last one that I did with Dr. Neto Rosatelli, the prolific surgeon from Brazil, that was widely appreciated all over already. I actually planned that meeting for about 1 hour. The meeting went on for 2.5 hours. So those sort of ophthalmic-related educational activities have been going on. But this is something. See, whenever I plan a program, it's based on something that is related to my life. So a surgery, so what I want, or practice what I want, even medical retina what I want. So I feel that this is something that a common ophthalmologist also would be looking at to find an answer for. And being a first generation ophthalmologist, born to parents who are pretty middle class, so money. That security factor of money was always sort of bugging me. That it doesn't give you a lot of confidence when you're quite young. Like yesterday, we had a program on midlife crisis in our district ophthalmic society. So there was a graph telling that the happiness dips during midlife, and then so my contention is that for me personally, my happiness increased probably as my midlife started, because the financial security in me kept on increasing. But still, the problem with many of us who are in the private practice on the private sector is that you don't get that pension that the government servants do get. And you don't know how much. I really don't know how much savings I should have to retire. See, many like me are not going to retire from the practice of ophthalmology, but we should have a confidence that okay, see, I can aram se do my practice, enjoy my ophthalmology practice, or whatever medical specialty that you're practicing, without any concern of that security issue for the money, cash balance, or the savings balance that you have. So this is why I thought of this program, and I talked to Dr. Umesh. Umesh, Srikanth, and Dr. J.K. Reddy are the people whom I go to for any questions related to ophthalmology or anything in life. And Umesh said, yes, Srini, we can involve Wellcon in it. See, Wellcon, you might be aware of it. It's initiated by Dr. Ram, and it's a group. Thousands of doctors there. They're being taught how to save money, how to actually plan for retirement. So that is a different idea. That's not what I wanted from this meeting. I wanted to give an idea to everyone as to how much savings each and everyone should have to actually think of retiring from the financial aspect of your life, like the money making or the savings improving aspect of your life. Let's continue to work as an ophthalmologist, but let's stop getting worried about your bank balance and all. So we have Dr. Ranjith, who is one of he's basically an orthopedician, is a spine surgeon. So there are a lot of experts like him in Wellcon. So the Wellcon people said he would be the best person to speak on that subject, and he's the person who is going to talk on this subject today. And we have today the most powerful ophthalmologist in India, the most important ophthalmologist in India, Dr. Ranjith Unnikrishnan, the president of All India Ophthalmological Society, with us. So he will be sharing his feedback on this topic. And Dr. Umesh, as I said, he's a CMO of Shankara Eye Institutions, Bangalore. So he's also an expert in investment and everything. And Dr. Sharad Babu from Warangal, he has recently sold his practice, and so I'll be asking him his experience about how to increase the value, how to go about it, build a practice, maximize the value of that, and maximize the returns from your practice. So this is generally what we are planning. And a few words from Dr. Lalit Verma, and then we'll go into the presentation. Lalit, sir.
Thanks. Thanks, Srini, for having me here. But you see, a lot of people say, what is money? Money se kya hota hai? But I have always believed money is everything. Money is everything means that money to me is security. Security in life, that I have some bank balance so that I do not fall, I am not found wanting whenever it is required. So money does not give me pride, ego, or anything, that my lifestyle hasn't changed just since 83 when I started earning money, but gives me security. And I keep telling as a broad this thing to everybody, my colleagues, my juniors, my fellows, that 50%, jitna kamaate ho, 50% you should be saving. Reason being, I have, I came from a very, very small, poor family as this thing, but I learned that money ke bina life mein kuch bhi nahi. But coming to what you were saying, and thanks for, thinking this out of box, KSOS for last couple of years, and being with you as Chairman Scientific Committee, apart from routine education activities, these out of the box webinars are very, very useful, especially for people like us who are entering into a retirement age. But you see, retirement, what I believe is a beginning of another innings of life. It's an opportunity where you can follow your passion, whatever your passion may be, whether travel or community work or, helping children, whatever. But very, very important is very pertinent also to take care of your health. Because if health is not there, all this planning about retirement, all this goes for a six. And for this, you have to keep yourself active, walking, yoga, other things you do. But I'll just conclude by saying that retirement is not the end of your innings. It's not the end of your innings. In fact, it's the beginning of a new inning. And what I say is, do not retire. We should say, do not retire, but refire. And with all the good health and if you have, then is the relevance of this talk by Dr. Unnikrishnan, that how should you plan? And believe me, as I was mentioning in the beginning, doctors are very, very poor planners. Once I say this, that is most of us, believe me, because our main life is spent from 30 to 60 or 65, when we are stuck in our professional ambitions and making our careers and, roaming around to make a name and fame for ourselves. But that is the most crucial aspect. When that is the reason I keep telling my fellows, 50% you should always save. But I want to hear from Dr. Ranjith is that what decisions should we be making at what time? And there are a couple of pertinent questions. Maybe if time permits, I'll ask Dr. Ranjith. It's very, very crucial. If you have to enjoy your second inning means, when we retire. And also you should take into consideration that luck always may not be on your side. Like a surgeon, you may lose your hand, or some health issues may come up. Therefore, I always also believe that you should always have a second source of income. Apart from, ophthalmology, or apart from, your surgery part, you should always have some second source of income so that you don't, are mercy of anybody. So very happy to be here, Srini, at your invite, and looking forward to tips from Dr. Ranjith about retirement. Thank you.
Okay. Umesh has also joined. Umesh will join the discussions after this. So I'm not introduced myself. I'm Dr. Srini Unnikrishnan. I'm the chairman of the scientific committee of Kerala Society of Ophthalmic Surgeons, and we are lucky to have Dr. Ranjith Unnikrishnan. He's one of the best spine surgeons in Kerala. I mean, he goes around giving talks on this world over. The first time I called him, he was in Bangladesh demonstrating and doing all this. But many like him, Umesh, Dr. Ranjith Unnikrishnan, all have learned how to see. Lalit sir said, save. But it's not for people like Dr. Ranjith and Dr. Umesh. It's not just saving; it's multiplying your earnings. So Dr. Ranjith, we have taken quite a bit of time for introduction. Can you please start your presentation?
Thank you, Dr. Srini. Thank you, Lalit sir. Thank you, Thomas George sir, and the entire KSOS for this invite. I am representing WealthCon, which we'll see eventually what it is and how it has changed the life of at least 55,000 doctors. So if I can reiterate, let me give my disclaimer. I'm not a finance expert, neither am I a financial planner. All I know is what I learned from WealthCon by our mentor, Dr. Ram sir, how he started this and how the idea of the entire WealthCon movement is to make the doctor Atmanirbhar, to be independent. And on the right context, as Lalit sir mentioned, let us see how we can refire without retiring. So saving is one thing, and planning and letting it generate income for you is another thing. So we'll split into two parts. I'll just go through a basic presentation, and then at the same time, we'll have some time for questions. Is it okay, Dr. Srini and Lalit sir? Is it okay?
Yeah, absolutely.
Yeah, absolutely.
Right. So I think I'm on a very low network area, so I'll just switch off my video. Is it okay, sir?
Yeah, absolutely. Your presentation is seen, and it's fine.
Perfect. So with this, let me start. So the first, the topic which Dr. Srini wanted to discuss was that when can an ophthalmologist retire, or what are the prerequisites for a retirement? So to introduce myself, I'm Dr. Ranjith Unnikrishnan. I'm an orthopedic spine surgeon. I work in the capital of Kerala, Trivandrum, in a private practice called KIMS Health. I am into WealthCon since 2018, and I've learning every day, picking up things as the whole movement goes ahead. So exactly what are the prerequisites? By this, what we exactly mean is that it is financial freedom. So Dr. Lalita was mentioning, when can you say that, well, now I am financially independent? So essentially it means when are you financially free? So the entire idea of WealthCon, you can look up the WealthCon India website. It is darkness to light, from ignorance to knowledge. So another disclaimer, we might take up some names of some mutual funds or platforms, schemes, etc., which is purely for illustration. WealthCon does not endorse any financial agent or anything for anything. You should do your own research before investing. Now we have this thing, in any of our WealthCon presentations, we show the swan or the Rajhans, because whatever I discuss here might not be applicable or acceptable to all of you or any one of you. You can take what is good for you and you can just discard what you don't like. The same way the Rajhans drinks the milk and discards the water. So you can take what you want. We might have there might be huge traders among you who are professional traders, might be long-term investors. People have different capital for each person. So let us discuss. You can take what is applicable to most of us, and then we'll go ahead. So this is a very interesting presentation, a picture which I got from the internet, which says about the financial life of a doctor. If you look at the x-axis, Our first 28 to 30 years is spent in education, when most of our engineering colleagues or businessmen start settling. The next 5 to 10 years is busy getting married, having kids, or starting an hospital. The next 15 years is in our accumulation phase, wherein you start to earn something, you buy a house, you buy a car, your kid starts going to college, and eventually you come to a stage in your 60s or 50s when your kids are getting married, and in 60s, early 60s, mid 60s, you think of retirement. Like Lalit sir mentioned, in the 50s, we start thinking, now we have to plan for retirement. What do we do? In any of these times, you can see we can have any emergencies, health-wise. Larissa mentioned a very important domain. It's not just financial domain. Health domain is equally important to us, because unless we are healthy, we have no way to enjoy the money what we make. Now, before you start any planning, the end point should be very clear. So this is an Excel which I will share with all of you via the KSOS. A small Excel, it says you should first know thyself. The financial background, knowledge, capital of all 6 of us sitting in this Zoom room might be different. For all that hundreds of you are listening, it might be different. So we should know what are your goals and how much you earn, and try how to increase or multiply from what you earn, other than looking at somebody else or how much he earns, because we all have invested a good part of our life into updating our skills or refining them, so that we empower ourselves to make our income more. So in this style, you have to know that we should know what are your income and expenditure. We should know what our salary, which might be your consulting income, might be your if you're full-time in a hospital, you might have a salary. If you're a part-timer, you might have salary plus consulting income. Then you might have assets which might give you a rent, or you might have investments which will give you appreciations. So all this has to be accounted for, because unless you know what you make, you will know what you can save. Like sir mentioned at the outset, it's ideal to be able to save at least 50% of what you make from the start, but it might not be practicable for all of you, all of us. Once we know the income, we should know what our outflows. The different outflows we can see in our Excel, which I'll share with all of you. Now, this is the most important part we should know when we start our investment journey. All of us might have different goals. So this calculator will tell you based on, you can look at these values here. You can say, what is your goal? So first goal might be for youngsters, buy a home, or goal 2 might be buy a car, or goal 3 might be kids education, or the 4 might be kids marriage, or your retirement, your vacation, your holiday, whatever. So we should know what is the current value of that particular investment or expense. And we should know at what is the probable year in which we have to realize that investment. So this tells you how much years you have for it. And we all know that inflation gets getting varied in 6 to 7%, currently it's around 7. And this will tell you with an expected return of 10%, what is the future value you need for that particular goal at today's levels. Then this also tells you how much monthly savings you require to reach that particular goal. So you can customize it to your need. Once I share the goal with you, share the calculator with you, it's very simple, straightforward calculation. And if you look at it, there are end point is clear. Inflation is not under our control. Returns, we are taking a modest 10%. So if you look at the equity market, it requires around 18% per annum, 18 to 25% per annum returns. Mind you, what matters is not the expected return, it is the PTPR, post-tax, post-inflation returns. So if you look at our bank FDs, the so-called 6%, if we all of us fall in the 30% tax bracket, after counting for inflation, we are negative. Our capital is eroded, not appreciation. So like we think, FD is not a good source of investment, but we still have to have it. Let us see why. Let me at the outright put up the most common mistake which all of us doctors come to see. So in our accumulation phase, when you reach this phase, you start getting some money. There are hundreds of people coming around to you saying that, doctor, give me so much of money, we will invest into a PMS, into a portfolio management system, scheme, we will give you X amount of return per year. If you look at the right side of the chart, look at the blue line, which is the agent income, and look at the cumulative profit. You see, as time progresses, the agent after 40 years makes 4,76,000 rupees, and you 4 crores, and you make 7 crores. Why? A lot of it goes on frequent turnover. So PMS is the most commonest and the most futile decision made by any doctor, because they are bothered about their money, not your money. So thankfully, the COVID was a blessing in disguise for most of us. We learned to value our life. We learned to value our family. And most important, most of us had zero income during the lockdown. So this made us time to introspect, and we thought in terms of what is financial freedom. If I borrow this lines from the book Psychology of Money, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today, not bothering about where the money will come from. Like what Dr. Lalisa mentioned right now, when do you say, how I can be financially free, do things what I want to do, when I want to do. And look at these 3 milestones in the life of a doctor. You should understand what is our annual asset income, what is passive income, and we should always know that it should be more than our annual expenses. So you should be able to collate your annual expenses, and you will know your annual passive income. Now, annual asset active income, when your annual asset income is more, the passive income is more than your primary income, that is the second stage when you say that you are becoming financially free. So you can think, what is this active and passive income? When we go to work, or you have practice, you get a salary. That is your primary active income. Now, when your investments create monthly returns, which is more than your active income or prime income, that is the time you know that you are financially free. Meaning, even if your primary income comes down, you are going to have your passive income running. So that is the second target. And third is, by doing the second process well, when you reach a stage where you have enough funds to survive 20 years of your life with your current lifestyle, with inflation expected, without any active income, that is the time when you're ultimately financially free. So I repeat, when your funds, when your reserves reach to a level in which you can survive for 20 years without any primary active income, that is a stage when you're ultimately reach financial freedom. So which we all should try to reach, but at least the second stage is which we all have to definitely reach, wherein our passive income should be more than your active income. Now, this might vary for each person at each city or country or taluka or state, which is speciality. Ophthalmologist might earn, say, 1 lakh a month, probably in X city, and that somebody might earn 10 lakhs a month in X city. So the guy who's earning 10 lakhs a month, if his monthly income from his passive income is more than 10 lakhs, well, he's financially free. Now, that's the difference between being rich and being wealthy. Like Lalisa mentioned a good quote at the start, what money is not important, but whatever is important needs money. We in India are taught to look at money and the thing with S as taboo. No, it's not taboo. Money is not important, but everything what is important in life needs money. So you should know that what is the difference between being rich and being wealthy. Rich means having a lot of income, you spend a lot of money, show off how much money you spend on Facebook or Instagram, or have a very luxurious car and all that. But your net worth is negative, meaning your spending is more than what you earn or save. So it's very easy for a doctor after starting practice to get a loan and just splurge. That is where the biggest mistake starts. Being wealthy is what? Being wealthy is having time to do things when you want to do, time to spend with people whom you love, time to learn things about what you want to learn. So true wealth is health, freedom, and relationships. Remember, money buys you time, which ultimately gives you freedom. And that's what we all want to achieve. We have spent a good amount of our life trying to reach where we have to reach. Now it's time to pay us back. Now, this is a formula which which has been reiterated many times in our WealthCon. So wealth is equal to P into 1 plus R raised to N. So I would request all of you to write it down or just remember it. What is wealth? Wealth is is your wealth, what you want. What is P? P is the capital which you have. R is the return percentage. And look at it, N is the time, which is exponential. So starting early is the most important thing for creating wealth. So those of you in your early part of life, you're very lucky if you get to realize this very early in your career, that W is equal to P into 1 plus R raised to N. So P is capital. Like sir mentioned, if you can save 50% of what you earn every month, your P is going to be immense. So we have spent 20 years or 28 years of our life trying to create ways how to increase our P. Now, rate of return. That is where you should know how to utilize your knowledge and resources to create more returns than putting in an FD which gives you 6%, which is not even fighting inflation. How should you increase your percentage of earning? N is position, time. So in WealthCon, we say PDF. That is patience, discipline, and faith. Patience is time, discipline is mind control, faith is believing in your investment. So this is what we should always remember when you start with any of your investment formula. So any principle, the first thing of investment is know thyself. So Dr. Ram has made this mnemonic called target. That is, T is the time, how much time you have to reach that particular goal. What is your age? What is your risk appetite? What is the goal? What is your expertise? And what is your time to track the market? So based on this, each of us could be a passive investor, an active investor, or a trader. We will strictly keep trading out of this discussion because we are talking about personal financial management, not talking about trading. Trading is somewhere where the market gives you monthly income. So at WealthCon, we all start as passive investor, move over to active investor, and then if you have the risk appetite, the expertise, and the time to track the market, become a trader. Now in WealthCon, there is a TMP course, which stands for Trade Vesting Mentorship Program, which actually Dr. Ram does online, hands-on sessions where we are taught as a doctor how to trade. And eventually, I think if you master that, we can retire probably in your 30s or 40s. Now, before you make any investment, so from the calculator, we know that what is the corpus required at the current rate of inflation and investment at what time. Now, before you make any, might have people come to you saying that's a LIC, put money in this policy, in this plan, child plan, health plan, mixed plan, this investment, this project, this land. Before they all speak about return, so you'll get so much return. Remember, this is the formula or the sequence which you should always think when you make any investments, called Cutler. What is the actual cost of investment? Meaning what will cost you? What are the tax implications? A government fee and tax regimes, they eat up nearly 40 to 50% of our income, what we make. So we should know the tax implication of what particular investment. Look at the liquidity. This varies because you need money when you need it. So you should be diversifying or going into different asset classes. You will see individually to need money when you need it. Now, then the risk. What is the risk of losing that money? And the last is return. Whenever an LIC agent comes to you, just speak to him, what is your return percentage? But don't ask first return percentage, ask him the cost, tax, liquidity, risk. If he can all answer that, then go to returns. Now, remember this mnemonic, GRED. G for gold, R for real estate, E for equity, D for debt. So GRED are that 4 asset classes which we have for us in India to diversify. I repeat, GRED. Now, this percentage allocation should vary based on your age, because we saw in the target formula time and age. So somebody in his 50s, when he starts looking at investment, or somebody in his 30s, when he starts looking at investment, it's a different perspective, because somebody who's young has got more risk-taking capacity, has got more time for his money to mature, because we saw W is equal to P into 1 plus R raised to N. So the N factor is more for a younger doctor, whereas compared to somebody in his 50s or 60s who want to retire. So roughly at Welcon, we have this rough diversification. So when you're 30 to 40 years of age, 5% of your investment should be in gold, 40% real estate, 50% equity, 5% debt. Very few of us will be in that age group. Most might be in this 40 to 50 age group, wherein gold 10%, 40 between equity, real estate, and 10% debt. Here I'd like to emphasize, real estate is the house which you live in is not your investment. It's actually a liability, because you know that it will create taxes, has got running cost, electricity. So those are all eating into your investment. So that's, if you have a second house or a commercial property, etc., that will create value, will give you income, that becomes your asset. So your primary house you live in is actually a liability on financial terms. So we will not go both a lot in real estate, because real estate has got its own liquidity problems. So that leaves us with gold, equity, and debt as our avenues for investment. Now we will see individually each one of them how we should plan. First thing we say, don't put all your eggs in one basket, because we know that gold and equity goes opposite. Debt is something which always keeps your money safe, and equity and real estate also is very volatile. Now, gold, we all think in terms of investment into physical gold. Remember, with due respect to all the female colleagues in this audience, physical gold ornament is again a liability, because you know that it has got making charges, depreciation, etc. At Welcon, the way we say to invest in gold is not in jewelry, but either physical gold in gold coin and bar. But we know we all have got limitations investing it. Next and most popular is paper gold. In paper gold, we have three common avenues: sovereign gold bonds, gold ETF, that is exchange traded funds, or gold mutual funds or futures and commodity. Out of which we will not go to the last two. Future and commodity is part of trading, which is not the purview of the stock. So we'll just go on buying gold bond with gold base. So this might be too extensive for you. I will share this screenshot with you to go into great detail. All of you can join Welcon. I'll give my number at the last of it. You can join the group. It's free. The only prerequisite is that you should be an MBBS doctor. So everybody is inducted into Welcon group only after checking your degree, that you're an MBBS doctor, not a dentist or not any other allied specialty. You need not be a postgraduate. So these are the ways, difference between each of the physical gold and gold bond. We will not purview into great detail because of want of time. Next is that how to invest in gold. Now, any investment has got two avenues: either SIP, stands for Systematic Investment Plan, or buy on dips. Buy on dip meaning either the market crashes, you have cash, or you get excess cash without planning. That is by buy on dip. SIP is that we buy X amount of gold in any form every month. Or, in India, we had the tradition of buying gold in muhurats, like Akshaya Tritiya or Diwali. We keep buying, we buying gold because of muhurat, because that was the way the ancestors planned about buying gold. Next comes we will not speak about real estate, equity. So what are the avenues of investing in equity? We have three avenues: either by mutual funds, or by directly trading into equities, or last by future and option. We will not keep future and option because that is a trading. It is not investing. We are talking about investing our money, not trading. So that leaves us with two avenues: equity, which leaves us two avenues, that is mutual fund and debt, of which a lot of our medical professional are in this group who invest into equity, debt, or mixed products via mutual funds. Now, here lies the catch. I'll just show a brief how mutual fund works. Suppose investor 1, investor 2, investor 3, we all are doctors. We don't know how to invest into mutual fund, into equity market directly. So we give our money to a mutual fund who, by the trustees or the fund management committee, invest into different companies, and the companies give income which is paid not to us but to the fund company, and the fund company will deduct their charges and pay it back to us, the investor. So there is an intermediary here, which is the AMC, and we are trusting him with our money. Now, the biggest mistake which most of us do is that we invest into a fund which is called the regular fund, wherein you as a doctor has got an agent in between, and then via the agent we invest into the AMC. Whereas if you do directly, you directly go into AMC. Now you will think, why should I know this? What does it matter? Because a lot of our money is taken via this distributor for his charges, whereas we can do it very easily if you go direct. We'll see into a chart. Now, how does a mutual fund give you money? So there are two types, which is growth, wherein the profit is reinvested, and then one is called dividend, wherein the income is paid as dividend. Remember, no doctor or none of us should take any plan in which there is dividend reinvestment, because it does not have the benefit of compounding. We are putting money to compound. So only choose growth options, never ever dividend payout. Never ever. Because our goal, see, there are two types of investment basically. One is capital protection, second is capital appreciation. We are looking at capital appreciation, our capital to grow when you invest into equity. Whereas when you invest into debt products like bank FD, even though it is going to get us negative return, we want capital protection. We want money, we don't want our money to go down, to go loss. That is it. So again, there are different tax implications which will not go into this, not the purview of the growth. Now look at these different charges. So if you see a lot of money is taken by the distributor or the agent for running your mutual fund, whereas all this money can be kept on your own if you do it directly. So all of us want to go into direct mutual fund. We'll see how, not via an agent. Now, if you look at it, there is the small disclaimer which says that mutual fund subject to market risk. It is not market risk, which is not under our control. It is the manager risk. If you have a poor mutual fund manager, he might give you negative returns, but he will definitely take his fund management charges. This is a small chart which shows how different mutual funds in the United States with respect to 1, 3, 5, 7, 10 years, where all of them actually lost money in the long term, whereas which when you compare with the equity directly. Now, there are different risks involved in case of, we discussed that before any investment, we should know what is our cutler risk. There are different risk factors involved in mutual fund. We will not go to great details. So when you look at the Wellcome group, there is different formulas which Dr. Ram has mentioned to see how to understand the risk of a mutual fund. So roughly three things: something called beta, something called alpha, something called Sharpe ratio, something called Sortner ratio. Come on, this looks very confusing. No. If you look at the filter which Dr. Ram has shown, wherein we can easily measure all this in a free website called valueresearchonline.com. I'm just seeing it down. I'm showing it down in this. The website is called valueresearchonline.com. You can just write it down and just search it. It's a very easily a free website where you can just make a free account and use it to understand all these values. We'll see how we can do it. Now, this is the chart which I was mentioning about when we see the difference in income with respect to direct plan versus regular plans. If you look at the left side, these are few popular mutual fund scheme, which are all equity, if you look at the direct and indirect plan, if you were to put 10,000 rupees per month as SIP, remember you're investing for long term. Just look at the difference between the regular and direct after 20 years. Are you willing to give 17 lakhs of your money to the agent just because he told you the fund? Not at all. You can look at the difference. 17 lakhs, 18 lakhs, 24 lakhs, 44 lakhs, 62 lakhs, 33 lakhs, and 0.3 lakhs. This is the difference between a direct fund and a regular fund. Remember, all the agents who come to sell us funds are selling it regular because they get their commission. Whereas we can do the same thing directly, and this 20 lakhs can be in your kitty. It is not into his kitty, right? Now, this was a very interesting data. 50% of all North American mutual fund portfolio managers do not invest a cent of their own money in their funds. So they don't put money in their own funds because they know that it is not the right investment. Now, this is the so-called, this is the KSOS criteria, which is devised by Dr. Ram, which looks at CAARESA, these 7 things, and decides which is the right fund for you. This is not the purview of the stock, so I'll not go into details. We can join the welcome group and it's freely available. There are 100 people to help you how to do this, videos on how to do this. Now, next question, how much to invest? Now, this is the welcome formula. Invest into a large cap, mid cap, and small cap fund. Never into any hybrid funds. Never into any of those funny ESG, PSG, pharma sector funds. No, if you should decide your risk appetite and split among these 4. Now, the 4th category was ELSS, which was equity linked scheme, which had a 1.5 lakhs exemption under ATC. Now that has been taken away by the present new tax regime. After there is no exemptions, no deductions possible. So you need not take that call if you are in the new tax regime. Now, Welcome says that at least 2 funds in each category. 2 funds which you select by this KSOS criteria, invest 2 funds of each category and do SIP into it. There are methods which we'll see how we can let this money happen automatically. So if any of you are into regular mutual funds, just please stop it. Just please stop it. Look at the KSOS validity of this fund. If it is there, you start that. If it is good fund, same plan, do direct. Same plan, do direct. Don't go regular. You're just paying to the agent. It might be your wife, your friend, your family friend, well-wisher. It does not matter. It's your money. You're working hard for it. Now, there are different ways which we can see eventually when you join the group, how we can do it automatically. I'll not go into details. Now, this is a common thing. I told you stop whatever fund LIC policy you've got because they are always taking your money away. If ever you stop, whatever money you get, immediately invest as lump sum into whatever plan you choose. Don't sit on it because there is this cycle of of optimism or pessimism. You might be optimistic, you might go to off area, come to depression, optimism. So you have to negate this cycle in your mind. Remember, mind management or monkey mind management is a big important part in long-term investment. Your mind plays more games than what your money can play, because you might feel very happy, I got some profit, you might put all your money into a particular fund or share, it might come down. So if you go to SIP, this negates the human emotion. It automatically your investment keep happening in equity. So whenever you want to invest you got an excess money, you can either do lump sum investment into debt products or equity products based on your risk criteria. Remember, whatever money you put into equity is the money which you don't need for 7 years. Don't invest the money which you need to pay for your school kids' fees or your school's tuition or your EMI. That is not to be used for investing. That is separate. You should strictly keep that money because SIP grows money only after minimum 7 years, not before that. Now, if you look at one of the most prolific and rich, wealthy investor, Warren Buffett, he started at 10 years of age. At 30 years, he had a net worth worth $1 million US. 97% of his net worth was made after his age of 52. What worked for him is not just his skill, it is time. It is the power of compounding. Just look at the chart. So start early, but it's never late. The longer you stay invested, the longer your money grows. The more you keep monkey mind happens, you keep churning your portfolio, you will have negative returns. So this is a chart which says that if you start in your 20s, by your 60s, what money you will have. You can understand what money you'll have. It's a rough formula. It's called the rule of 72. It is the time taken to double your money. So you 72 divided by interest rate gives the amount of time taken to double your money. So you know, if you look at the left-hand side, as the interest rate decreases, you will take more year to double your money. So if you invest into something which gives 12% per annum, your money will double in 6 years. If you into something you give 6% per annum, it'll take you 12 years. So that is why we should know why we should diversify among different asset classes so that our money multiplies in the most optimum way. Now coming to stocks, which most of us are very scared of investing. There is a criteria called MPTDS, same like the Karesa criteria which was devised by Dr. Ram to filter out good stocks. So it's called keep it simple and stupid. So very straightforward criteria. This is a filter used to screen good companies by your own. M stands for market capitalization, P stands for price, tax, dividend, sale. This is seen in a very free website called screener.in. Once you go to the group, you will see videos how to do this. Very simple. Anybody can do it. In fact, 7 standard kids, there's a WealthCon group called Fine group, which has got 7 standard kids. They can do it. It's so easy. If you just randomly look at the market, if you look at the screen, there are more than 4,000 companies. How do you make out which are the companies good for you? You apply this MPTDS filter. I will not go to the details for want of time. It's really available. And once you decide few stocks, this is the way we say. You have to diversify. It's called 3 Ds: diversification, dip buying, and duration. Like we discussed, keep it for minimum 7 years. Sip and dip. Make sure you buy X amount of shares for X money every month. Wherever you've got excess income, invest into it. And diversify among different sectors and classes, because we know that we should not put all our sectors, all our eggs into the same basket. Now remember, Cutler, cost, taxation. There are necessary evils for any investment. What are the necessary evils? It's brokerage, securities transaction tax, GST, exchange transaction fees, SEBI turnover fees, stamp duty. Roughly, this all comes to around 4% of your come to 4% of investment. So roughly 4% is what you lose by doing all this. Now, how do you build a portfolio? You determine the sectors, select stocks from each sector, and you reassess and rebalance periodically. Now, I'll not go to this because again, this is not the purview of talk. Now, we are talking about passive investor. What are the do's and don'ts? Start early. Diversify. Don't over diversify. Don't buy 20 mutual funds. Mutual funds are already diversified. Don't go on putting further 100 into them. Study the company well. Have patience, discipline, faith. Control your mind. Don't look at the money every day. 7 years is a basic time when you look at your portfolio. And whenever there is some panic situation in the market, buy from them and sell to them. That's how you make money. And always have some capital for dip buy. Always have some money in your hand, because you don't know, if you know that when the market goes, you should have something to buy it. So always have capital for that. Focus on good companies and great leaders. Don't go to stupid companies which might become bankrupt or get delisted very soon. Look at these. Don't invest on tips from any news channel, any brokers. I know most of us will be very aware that all these TV18, this channel, that channel, all these are paid buffoons. They are paid by companies. They tell what they want to well. Don't look at it. Avoid investing on penny stocks by any investor. Look, do you prescribe a medicine because your friend prescribed it? No. You read it, study it, see the results, then you read a paper, then you prescribe it. Similarly, don't let a 12th class pass guy or your neighbor who's not even graduate come and advise you about investment. So don't do that. Avoid jumping into trading without having proper training and education. So in WealthCon, we say that we spent 18 years to become, 15 years to become a doctor or a surgeon or whatever skills we have got. How can you be a trader by just because you open a Demat account? You're sure to lose money. Never catch falling knives. Without something price is available cheaper, don't just buy it because it might not be a fundamentally good company. And most important, do not invest borrowed money. Don't take the money which you have kept for your children's school, etc., and don't invest into it. Now, this is again index investing. It's a very straightforward way of investing into the Nifty 50 or the next 50. Again, it's probably we don't have time to discuss all that here because we need time for Q&A. So this again, what we say, some formula of Dr. Ram, how to do. So when there is market fall by 10%, by 10% shares from your funds, 20% fall, 50% by another 20%, some way of buying a dip buying. If you look at it overall over the years, our economy, we know that from pre-COVID levels today, we have reached 17,800 level is a Nifty level. India is bright, future is bright. We are definitely India has got a bright future. Our stock market is going to go up. So eventually, apart from the small dips and hips, eventually we are growing. Now, we should remember this. Risk management is very important as much as saving money. You should diversify, do dip buying, and keep long-term horizon if you're investing into equity. Now come to real estate. Like we said, they're poor for wealth creation. They are good avenues for passive income. There are huge capital. You cannot buy. You can buy a Reliance share for 2,000 rupees. You can buy, ITC for 300 rupees. Can you buy a flat for 300 rupees? No. So the tick size is in lakhs or crores depending on where you live. Whereas we can invest in 300 rupees, 500 rupees into any share you have got. Plus, there is very poor liquidity. You cannot sell the real estate when you want it. And most of the mongers there will make money when you are into a distress sale. So real estate is not a real good investment for us as doctors. Debt, that GRED, the debt part of it. Now, there are different debt instruments for us: PPF, Sukanya Samriddhi Yojana, Senior Citizen Savings Scheme, National Pension Scheme, mutual funds, bonds, as well as fixed deposit. Remember, the most important aim in debt products is capital protection, not capital appreciation. You don't want to lose your monthly savings which you kept for 6 months into share market. So you should know how to how much money to keep there. Now there are different risks in these products. If you go through each of them, they got different risk again, which is not the purview of the stock. Remember, the rough formula is to have 6 months of your monthly home total expenditure with EMIs into a debt product. I repeat, a debt product will not fetch you great returns, but it is important for capital protection. That is why you can have minimum 6 months to 1 year of your monthly expenses into a fixed deposit or a debt mutual fund, which has got number one avenue. It is capital protection. Whereas if you saw that you want the money to grow or multiply, we know 72 divided by percentage. 6% is 4% is something what is given by the debt products, or 5%. Equity gives 12%. Naturally, equity will double your money sooner than debt product. So you don't want to keep that money in your debt in your debt product. So to conclude, all of us have to reach that stage 3 where we have 20 years of we have got funds enough to 20 years of our expense. We can live free. You should GRED, diversify between gold, real estate, equity, and debt based on your age class. You should manage the risk and returns. If you manage the risk, returns will automatically follow. And finance and should not be outsourced. You should do it yourself. I'll not explain the SXX part. So thank you very much, KSOS, Dr. Srini, Lalit sir, and the audience. Now you can WhatsApp me on this number, and I can give you the WPI or the WealthCon Telegram group link or the admin's number, who will verify your MBBS or MS or MD degree and induct you into the WealthCon group, which will be biggest break for you. And I request every one of you to please get your colleague. We should not be at the mercy of your hospital owner. We should not be at the mercy of a court who tells us that throw your degree if you cannot come to work. We should not be at the mercy of being beaten up with somebody. After being beaten up, we have to go back to work next day because we have to earn to live. So the aim and the hope and the goal of WealthCon, Dr. Ram and everybody, is to make all of us doctors Atmanirbhar, so that we don't have to work for money. Money has to work for us. Thank you very much.
Thank you, Dr. Ranjith. That was a really wonderful presentation. You've really illustrated how to create wealth, as you said, to become Atmanirbhar. So that's how you make money. But let me ask you the question that I asked in the beginning. So how do you okay, this is how we are going to invest in SIPs and everything, but the target, so what is the target that you need to achieve? So that is so how do you calculate? I asked you, like, when I try to see what is my monthly expense. So this is my monthly expense, and said 20 years of whatever expenses that you have, if you have with you, yes, you can sort of retire, sort of. So this is
Dr. Shri, to answer the question, for all of us here, we might have different goals and different time scales, right? So what might be okay for you might not be the target for Dr. Lalit sir or Thomas sir or Umesh sir, etc. It might be different for each. It's like our dress which we have custom made, right? So for that, this Excel, look at this Excel chart. We can see the Excel chart. This is what I discussed at the first of the presentation. We should know what we make and what we spend. Our net balance should be always positive. If you see this column number 46, should always be in surplus, right? So once you have control of that, then you can know what are your goals and how to achieve there. So you know what is your current investments in mutual fund, shares, fixed deposit, bonds, property, etc. And look at this goal calculator. Okay, so give me a value. So now your goal. So tell me that your number one goal is retirement. Okay, I'm putting it here, retirement, right? Now, at what is the current value you think you need to have to retire peacefully? Tell me a figure.
2 lakhs. You make it 2 lakhs.
No, 2 lakhs per month. 2 lakhs per month.
Sir, 2 lakhs, sir, that formula, if your monthly expense is 2 lakhs, then
24 lakhs.
You need to have at least 24 lakhs or at least 6 months, 8 to 10 lakhs in a debt product. It is not the corpus you need to retire. That is so you should have that money in your debt product. So you need 24 lakhs a year just to survive. It is not, it is your survival, right? Yeah, so definitely that is not the value you need to have to retire. So you should decide. So today it's 2023. We should decide, when do you want to retire? Tell me the year you want to retire.
Let's take it 2030.
Okay, fine. So you have how much? You only have 7 years to retire, say,
yeah,
right? So you have 7 years to reach your goal, right? So if you look at current values, if you look at current values, if you look at the current values, you need 24 lakhs a year to survive, right? So that is not the corpus required for you to retire. So you should at least have 20 times your yearly income, not your expense. 20 times your yearly income as a corpus to retire. That's a rough formula. So,
but I didn't get that. Let's see. My income. See, my expense might be 2 lakhs per month. But my income can be 5 lakhs, 10 lakhs, or 20
yes,
lakhs.
sir. Yes, sir. So you look at it like this. So roughly, if you have 2 lakhs per month expenses, and say you make 5 lakhs a month as income, your 3 lakhs expendable income, right? Your 3 lakhs for you to save. So
Yes.
if you use the 3 lakhs, so looking at the current inflation rate, the two inflation, one is our annual expression, our inflation index. Second is our lifestyle inflation. You might not, which most of us fail to consider. You might not want to drive the same car which you drive today after 10 years. You might not want to eat in the same restaurant. You might not want to do the same vacation. So there is also a lifestyle inflation involved. So altogether, your 2 lakhs is not sufficient for you to survive, for you to run your house after 10 years. Right? So you should count roughly, that's why the roughly 20 times, you should have your corpus. So if you go by that, you need to have at least say 10 crores, right? Is 25 lakhs per year, 20 years, right? At least say 5 crores.
That's just to survive, right?
That's it. That's right. So let it have 5 crores, right? Okay, 5 crores. So look at the first thing. So for retirement from to now to you from 10 years at expected 6% inflation rate. So it has moved now to 7%. Let us go to 7% now. Okay, at 7%, if you look at it, and you need so much 5 crores, you need 9 crores, 83 lakhs 57,568 to sustain your lifestyle. Expecting your returns are 10%. Let us say you joined Welcon, you became smart, you know how to make 12%. So you need to save 4.27 lakhs every month.
Oh.
Every month. This is data, sir. This is fact speaking. It is not.
I think Unnikrishnan, the first value, current value, that is the that should be 2 lakhs, no?
Yes, sir. Sir, this should be, sir. It should be yes, sir. It should be 2 lakhs. Per annum, 24 lakhs.
Okay, 24 lakhs. 24 lakhs.
Right.
No,
So,
this is 24,000.
Yes, sir.
This is 2.4 lakh. This is 2.4.
2,40,000. It has to be 24 lakhs.
24 lakhs. Sir, but look at it.
1 0. Okay.
If you look at it, future wise only 47 lakhs. So to sustain your present lifestyle, not expecting lifestyle inflation, you need 47 lakhs. For which you need to save 20,000, right? We know that this is not going to be the case, right? This is just for survival. This is for 1 year. 1 year, remember. So the longer you live after 2030, more the money you need.
Yeah. So you consider. See, how do you bring that into calculation?
Exactly.
Like after 2030, if you have to survive 30 or 40 years, how do you bring that? How do you bring that into this calculation?
So, Srini, I am telling you, if you go by formulas, you will have a severe headache. I'm telling you, do not go by formulas. I think the principles of what Dr. Unnikrishnan said, that should be understood.
Yes, sir.
That is more important rather than, you see, believe me, you can't have wealth managers with you because you're not willing to disclose everything. Today also, you are hesitating to tell you what is your monthly income. What I'm trying to tell you is, have those broad formulas which he has told. That is very important, like gold or real estate and, equity. Debt is not a very useful instrument. You see, your aim should be to have, first 3 lines which he said were very, very important. You have to have, like I said also in the beginning, second income has to be there. You purchase a real estate, once you get around, say, 2 lakhs rupees a month. That will give you peace of mind. and then you invest a lot of things in equity, that is SIP, and you keep only 6 months to this thing in your FDs or saving bank. That's it. So that is the biggest formula. Believe if you ask keep calculating formula every day in the morning, अरे ये क्या है इतना formula, वो तो नहीं होगा. That's impossible for doctors to comprehend. Impossible. है ना?
No, sir. See, I understand. See, that is whatever you have said is true for how to invest, increase the value, and all. I'm just trying to give listeners or viewers an idea as to see you should have a target. So this is the target that you have to achieve, and you work towards it. So that is what. See, this is something that.
I think he answered very clearly. As of today, for a middle-aged, that is between 40 to 50, 60, if you should have definitely 4 crore. 4, yeah, what do you say, sir?
So it is 10, 40, 40, 10. 10% gold, 40% real estate, 40% equity, and 10% debt.
So, Dr. Ranjith, I agree to this. I agree absolutely. That is.
Can I come in?
Yeah. Thomas. Yeah.
Okay. Srini, I think what you aimed at is how to get to a target.
Exactly.
All that Ranjith said is absolutely correct theoretically, but a simpler way to look at it is you have got X as your nest egg. How much can you withdraw per year? A 4% withdrawal per year is acceptable as something which can go on forever. The nest egg will never finish. So you have a requirement of 2 lakhs. Just multiply it. Take the yearly one, that is 24 lakhs, multiplied by 100 and divide by 4. You would have the nest egg value.
What is nest egg?
That is the corpus you are building at the day you are planning to retire. So if you look at that, I just did a calculation. So you want 24 lakhs and your nest egg should be 6 crores. I have not factored in inflation, which is where Ranjith's calculation comes in.
You have to
but if you can aim at
Thomas, therefore you have to factor in inflation. Therefore, it should be 4 crores, not 3 crores.
Sir, can I
no. If I am retiring today, I need 6 crores sitting there for 4% to be 2 lakhs per month.
Yeah.
I just want to.
I'm trying to get to an absolute number without bringing in the other calculation. This is also a retirement calculation that's
yes, sir,
publicized on different sites.
So you said Thomas, 24 lakhs multiplied by 100 divided by 4.
Yeah.
Yes, sir. Yearly,
I hope I got my question.
Yes, sir. Yearly expenses into 100 divided by 4. That is your withdrawal per month. Withdrawal per month.
And that is a corpus we should aim at for your retirement corpus, which you're not touching for anything else. Your child's marriage, your house and all should be outside of this.
So if you look at this Excel, sir, it factors all these goals. You can set up your individual goal, what it costs today, and when is the goal year you want to achieve it, and how many years you have got, what is the inflation, and what is your expected returns. So what we can factor in here is that we should increase our returns. We should increase our W is equal to the P into 1 plus R raised to N. We should increase our P, that is our capital, which we can invest, like what Lalit sir mentioned, that 50% of your income you start early in career. You are sure if you don't do any mental mathematics and don't do any big, don't churn your portfolio, you're sure to have at least 10 or 15 crores by the time you're in your 40s or 50s. And anybody, I'm sure in India, a middle-class doctor can very well happily survive with that amount of money.
But this should be in an equity instrument, no?
Sir, we should diversify there. That is where GRED comes in. Say you put all in equity. If equity goes down, you see, we know 2 things: capital protection, capital appreciation. Capital protection happens in debt instruments. Capital appreciation happens in gold, real estate, and equity. So again, there we have to diversify. Most doctors get cash and pump all into equity, all into real estate. which is not the smartest form of investment. If you look at the data, real estate does not give more than 6 to 9% of, or 12% if you factor in the different booms and all that over the years.
Only on a good day also.
On a good day also, sir. And also, if you look into
long-term real estate will only give 5 to 6%, not more
6%,
than that.
yes, sir. Exactly, sir. So 6 to 9% is the max you can get. And again, unless your commercial property, it does not give you a return. It does not give you income. So all what you get is via your asset appreciation, which happens at the rate of 6% or 9% at the most in the whole scheme of things. So if you want to become financially free, wherein you have your capital should be protected, plus you should get returns, everyone, as Thomas mentioned, so you should have some kind of income from the real estate. So if you look at if you look into real estate property, depending upon which part of the country you are in, it does not fetch more than 2% which 1% per month. So 1% per month is 12% per annum, which is more than that is created by equity. Equity, if you look at Nifty Bs or just into index investing, somebody who blindly invests money every month into Nifty Bs or ETF is sure to make 16% per year. No mental mechanics, no mutual fund manager, no great calc, just blindly do SIP into Nifty. Because
SIP into what?
Into Nifty, sir. Nifty 50, that is Nifty Bs.
ETF, sir, exchange traded funds.
Exchange traded funds. You have got very less fund management charges. You have got no mutual fund guy in between. You and the AMC directly, you're sure to make 12 to 16%, which is beating real estate. So what? And tomorrow you need money, just click of a button on your mouse, the money comes into your account. 24 hours. Imagine the same thing you do with real estate. You have to go behind the broker, put ads, spend your practice time trying to negotiate, then half cash, half white, all these headaches, which is not, if you see, real estate has led to a lot of Mahabharata in many families. So actually, other than the house you live in, unless you're very prudent, having real estate is not a good avenue for us. So that leaves us with gold and equity as our avenue for investment. And that is which grows. Gold does not grow as much as equity. Gold grows at the rate of 6 to 9%. Equity grows at 12 to 18%. We are very smart, even 20. So at WealthCon, people who trade on an annum look at 25% as their returns per annum. Remember?
I guess real estate is not for a one-time money. It is for a recurrent money that you can get, which you cannot get from gold or anything.
Sir, provided you have large capital to invest, because the ticket size is big. You cannot buy real estate for 1,000 rupees.
Yeah.
You should have a lot of money to, invest in lakhs or crores, depending on which part
I think you missed one aspect. He very clearly said it should be a commercial property. In most cities, if you buy a flat and the EMI for the flat will actually be higher than the rent you would get out of the flat.
Thomas,
and
the
you have to maintain the
problem
flat.
Thomas, the problem with commercial property is, you see, suppose you have had some, once you rent it out to big, outlets, then, then they don't vacate or they don't pay. What happens to that issues?
Next 30 years, you've lost it.
Yes.
These are all the risks involved, sir. These are all the risks. And
those risks, that is the hidden risk, I'm telling you, that is the fear in the mind of a lot of people. Like,
Actually, I do not agree with this 40% on property, other than when you want to self-use it.
No, what property, 40% is impossible.
Bad.
So, sir, all the money you can invest in equity, sir.
Yeah, equity, I agree. You can, study the market and, do it yourself. One lesson I learned today from, Unnikrishnan, do it direct. You see, a lot of times I have been doing it through my agent only, and I think he's making more wealth than I am making.
Absolutely. Your day is done, sir.
This
is the most important.
If you look at
there's one more point I would like to bring.
Yes.
That is the reason why we should have a good amount in the debt. I would say debt mutual funds are preferable over FDs because it's more tax efficient. Is that On the day you want money, the market may be down. It might have gone, you can expect a depression anytime. And that time you have to weather it up before you actually pull it out. That time you have your emergency requirement taken out of the debt. You have emergency funds as FD,
Thomas sir,
very
Thomas sir, if I may pitch in,
Yeah.
From this April 2023, whatever tax efficiency was saved by the mutual fund is out. It is now, it is the STST same as in your same tax bracket. So liquid mutual fund does not give any great advantage over your FD right now, sir. From this April 20.
Okay, so that's out.
That's out. So you can choose your product. It's no point. You can put your money into FD or wherever. And another thing is that when you put FD into any brand, remember our primary aim is capital protection. So any of these XYZ banks might be at risk. So what the government of India, recommends is to put in any of the three DSIB, domestically important, domestic bank of significant importance, like HDFC, ICICI, or SBI. Rest all banks stand the risk of losing your capital. So
yeah, in fine
that is the
print,
RBI. RBI is too big to fail. Banks are these three. That doesn't mean they won't fail. And all investors in banks are insured for, I think, 1 lakh or something.
2 lakhs.
50 lakhs. The bank pays, they get 1 lakh.
So now it is 2 lakhs. So you might have
2 lakhs.
You might have
50
10
lakhs
crores.
there.
You
Bank
have
pays,
10
you get 2
crores.
lakhs.
The RBI will give you only 2 lakhs.
So HDFC, ICCI, and
SBI, sir.
SBI, these are too big to fail situations.
According
to RBI last report.
Yeah, they're called DSIB banks. So these 3 banks in which you should have your debt component of your investment there, so that you will get it when you want it.
The problem with debt is it does not beat inflation also. No?
The debt is not supposed to beat inflation, sir. It is for capital protection. That is why we diversify, sir. We diversify because we don't want all our eggs in the same basket. We should have investments in gold, investment in equity, and investments in debt also.
So once you are approaching 60, your debt component increases. No?
Very much, sir. When you're in your 60s, you don't want to lose your capital. So you should rebalance your portfolio and shift money from equity into debt.
Yeah.
Can I pitch in?
Please, sir.
Yeah. Srini, one of the questions Srini asked was, how do you sustain a corpus for 20 years and not working? That is a very pertinent question.
Yeah.
I think partly Dr. Thomas sir has answered it. That is, your corpus, you withdraw yearly 4%. Okay. And now how that will work, go on for 20 years. How that works is, if let us say your corpus is 6 crores, you take only 4% of yearly 4% of the yearly return that you get, assuming that the 6 crores grows at 12%. Let us assume at base case 10% or 12%. The remaining 6% or 8% which compounds, that is going to help you sustain
Grow your capital.
And that is how typically retirement funds work. And that is where your diversification is important for the corpus, to ensure that at the minimum you get 10% to 12%, so that you withdraw 4% and the remaining 6% compounds, so that you can sustain for the next 20 years. That's the most important thing of corpus at retirement.
No, this 12%.
Thank you, that's exactly what I meant.
No, what about the inflation effect?
All included. It is all included. It is all included.
Okay.
It is compounding. That the remaining 12 and all the more. That is why
corpus.
Dr. Ranjith was telling that you join WealthCon. I think I spoke to Dr. Rajesh Sinha also the other day and asked him to join. The reason is, if you join WealthCon, and which I am also part of it, and you understand some principles of diversification and try to earn some passive income there, you can easily go up to 14%, which is very, very good. I would say is very good. 14% is twice in 5 years, doubling in 5 years. And if you can achieve that 14%, I think you will be financially literate, free. There's no question about it.
Yeah, 14% is a substantial percentage. It's quite good.
Yes, sir.
Rajesh, what did you say?
Sir, he was saying about the compounding.
14% is something which is 14%. Something which mean, would be desired by most, I would say. It's a very substantial.
You can use it.
Dr. Unnikrishnan, how is this idea of having, because we are not experts, how is it idea of, having a wealth manager? I don't know whether reliable or not reliable.
No, that's what he said in his presentation.
Not
That's-
reliable,
that's-
sir.
that's one of
Not
the-
reliable. He will manage his income, not for you. So you can just look into. So he will, sir. It's simple, sir. They do business for survival, right? Why should he be bothered about your money? He might be your relative also. He's not bothered about your money. He's bothered about his income. The only way he can make income is churning your portfolio.
So that means you have to spare time, at least
Yes.
half a day in a week or.
No, sir. If it is passive investing,
automated. Nothing, sir. You
don't get-
blindly buy Nifty Bs. You blindly buy Nifty Bs every month. Bank Nifty Bs,
So
junior
you
Bs.
need to spare time for one day to decide which all mutual funds you're taking, put an SIP and believe it for the next 5 years.
And forget it. Fill it and forget it. Shut it, forget it.
If you keep looking at it in between, you see the dips and you'll feel panicky and you may actually withdraw it, paying the exit loads also, which may go into negative.
No,
at the
honestly,
start.
I can share. I did that. I have done it also. But only thing is that agent is in between, because when I was in AIMS, we didn't have any time for all these things, and that agent still continues for more than 20
He
years.
has eaten away a significant portion of your money, sir.
Yeah.
Now, if
So-
you,
That's what I feel. I'm also losing out a significant amount of money.
So tell me,
Because the agent is there.
Dr. Unni, how to get rid of that agent now?
sir, just tell him from tomorrow, please stop my SIPs. I don't want SIP from you. And
No,
just
I'll give an idea, sir. I'll give an idea.
Yeah, please.
Whichever AMC you have, let us assume you have put in HDFC AMC or something, or
Yeah.
Axis. Let us assume you took Axis long-term equity fund. You go to the Axis mutual fund website, register. It's a very 2-minute process. Register, put in your folio, add it, and there is a one-click, convert it into, reinvest into direct from regular to
Okay,
direct.
okay.
It is done. And then from then on, you can put a mandate to continue your SIPs in the direct portfolio. The same folio. You don't need
You need not talk to your agent. You can directly do it.
no need to talk. If you ask him to stop, he may not agree one. Or if
Yeah.
you withdraw, you're liable for long-term capital gains. So you don't need to do that. All you have to do is ask them to switch to direct platform.
Directly you go to each, like I have 3,
Yes,
4
yes.
Axis and
You
HDFC.
you can go each, and then you can do that. It's a very simple half-an-hour process.
Go to the website. Go to the
So
website. Go to
finally,
the.
the folio is in with your PAN number and your Aadhaar number. So you
Yeah,
can
yeah.
go straight to Access, register, put in your PAN number and Aadhaar number, and you can do what you want.
You get
don't
it.
really need
KYC confirmed. It's all online, and then you add your folio. So your folio is there, but it will show as a regular fund, and then you instruct them to convert to a direct fund. That's all. So
Sure.
from then
Sure.
on, from now,
Then I'll get a phone call from that agent.
exactly, sir. So I was coming to that, sir. Number one, you should be very sure. He will tell you, sir, you lose your money. He will show you calculations that how much you will lose. It is okay, no problem. What you gain will be definitely more than what you will lose.
So you have to go to individual website.
Yes, sir.
Yeah.
Then again, you should decide. You should see
Sir,
if your
sir, there
funds
is one
are in
more
the DMAT form or in the folio format. There are
No,
two
folio only. I have
formats.
folio only. I have only folio.
So you have to go to the website and do it. Or if the agent doesn't help you, you can go to the office and speak directly, give your numbers. He will verify yourself and he will do it for you.
Okay.
Or if you join Wellcon, sir, there is a big flow chart step by step, what Dr. Umesh sir mentioned right now, how to do it.
No, that I will join immediately after this.
So
to
these are
join
future
Wellcon?
SIPs you can do direct.
So I was trying to request Srini in case, Srini can find out a slot where we can have Dr. Unni at our Kochi conference for some time, because I think it is going to benefit a lot of people. All of us are, like I said in the intro of this webinar, we are all stuck between 30 and 60, doing surgeries, doing all these things. And later, when at the twilight of your career, you think, "Arey, ye to kuch save hi nahi hua zyada." No, save to karte hain. We do save, but instruments like direct, like SIPs, and all this cred, what you said. So those sometimes we take it for granted.
So the other point is, sir, saving, which can give you a return of 10+%. That is more important. Overall, diversified. can give you 10 plus.
Overall, I agree with you, Umesh. So overall, at least should we beat the inflation, na? You see,
It is PTPIR, post-tax, post-inflation return. It should be post-tax, post-inflation return of at least 8 to 10%.
Yeah.
So to have a PTPR of 6 to 8%, you need to have a return of at least 18%. Because 7% inflation, and if we all form in the 30% tax bracket. So you should be able to generate that money after post-tax, post-inflation, which can build up your corpus from which, when you retire, you can withdraw 4% per year.
The other thing is which worries, Srini was asking about per month. Suppose we retire, and how to get that per month from these instruments.
So there are two ways.
Withdrawal plan, sir.
SWP from, if you have got a mutual fund, it is SWP, where you withdraw X amount every month into your current account, where you get as money. Second way is that if you have got stocks which give you dividends. So if you invest into any company which is MPTDS wallet, which we discussed briefly during the presentation, which Dr. Ram has devised, so they all give dividends. So the dividends come into your account as cash. Remember,
I'm not talking about dividends. I'm talking of from SIPs once you have invested.
SIP, sir, you can do SWP, systematic withdrawal plans. And if you're holding stocks, the dividends come to your current account, sir. They come as cash. And if you have got significant amount of stocks which give you decent dividends, that dividend is enough to give you monthly incomes.
So can at any point of time, I can, ask this SIP where we have invested that, that like 1 lakh or 2 lakh per month, they should into my current account.
Yes, sir. That is the SWP, systematic withdrawal plan. Just like the SIP, you can give a request saying, I need 5,000 every month in my account. So it will come out from
that can be done anytime. That can be done anytime.
Yes, website is very easy. You can go, it is self-explanatory.
Automated.
It's all
automated. Sir,
except for the
long-term
3-year lock-in.
Anji, lock-in.
The tax-saving mutual funds have 3-year lock-in. Except for that amount, anything else can be systematically withdrawn.
The ELSS. Sir, that is again out, sir, because
lock-in.
Sir, they got 3 again. They are out because government has taken out that benefit for us in the new tax regime. There is no deductions of 1.5 lakhs for that. So it does not make any sense if you're following the new tax regime to go into that, sir. So
can you please explain, so what has the new tax regime done for our investment in mutual fund? And so if that benefit for mutual funds is not there, would you advise investing directly in Nifty and rather than going through mutual funds?
So two things. In the new tax regime, all those standard deductions, 1 lakh for 1 lakh standard deduction plus 1.5 lakhs for ELSS plus 50,000 for NPS plus 25,000 rupees for health insurance plus another 25,000 rupees for your parents in 50,000, father 25, mother 25. All those have been given away. So there is no, if you go for the new tax regime, you don't get benefits of all this. Most doctors who will fall in the 30% tax bracket, it does not make sense to stay back in the old regime. So the so-called advantage of ELSS or PPF, which are two common instruments which are used for Section 80C deduction, is out right now. Next, debt mutual funds, which like Thomas mentioned earlier, they used to have 15% tax bracket. Now it has come into your tax slab. So if you're taxed at 30%, your debt funds are charged at 30%, like the interest you get from your bank FDs. So it does not make sense to deal.
So all these advantages have been withdrawn now.
Yes, sir, from April 1st, 2023. And another thing, if you are a professional, if you opt from the old tax regime to the new tax regime, you cannot go back. If you are a salaried employee, you can shift to and fro. And as far as I understand, this will stay on for another 2 years. After 2 years, the government will make it compulsory for all of us to go to the new tax regime.
Yeah, ultimately, yes.
They will increase the base price to probably 10 lakhs and do away with all these complex calculations of tax.
Now it is 7.5. Now it is 7.5. It will go to 10 lakhs in another 2 years.
What is 7.5 is what?
So now up to 7.5 lakhs, you can avoid paying income tax.
Okay, yeah.
By the new tax regime.
Hmm.
So why it was called a budget for middle class?
That's
Yeah.
debatable, sir.
There is one more thing that I would like to add. I think probably Dr. Unni forgot what we normally call as ignorance plans. All these LIC
Yes, sir.
plans.
Yes, sir.
you-
Sir, I did not want, because it was, we were talking
all
about.
these are all these are don't give you more than 4 to 6%. The maximum
Never.
purpose commission. So don't take any of these LIC policies, ULIPs or anything. And if you have, and if you are in the last stages, it is okay. But if you have just started, just shut them off. Even if you have to
Never,
use.
ever invest anything into LIC other than a term plan. So the most common way,
Absolutely.
when you start practice, they come and tell you, sir, this plan, that plan. If you look at the calculations, it's absolute nonsense. They make all the money. You know, the richest DII in India is LIC. How does LIC all the money? LIC is the, the way they make, like, LIC is sab kuch hai. And that's how they make money. So what you should remember is that all of us should have compulsory 2 insurances. One is medical insurance. Second is life insurance. Now,
Term insurance.
so
Term.
life insurance has to be a term insurance.
And there is no question
Term
of
insurance is where you pay only
that
for the insurance.
policy.
You don't get anything back unless you
In
die.
return. So the most common thing agent will tell you, sir, आपको कुछ नहीं मिलता वापस.
We
Fine,
do,
no problem.
Thomas, we do have a term insurance wherein you can exit and get some money as well. At your,
So then it's not a term insurance.
FBS,
If you
FBS is talking.
that is FBS.
That we know. That is not an insurance. That's a private fund of ours.
Yes, so,
Srini, it was wonderful, to be part of this. I have to be joining somewhere. And thanks, Unni, for this. And I will request Srini, in case we can have Unni in one of the, Kochi events. And let us, popularize this, website or value research online, in case we can, amongst our members, in case Unni does not have any,
no problem, sir. We all should join WealthCon, sir.
Not just Dr. Ranjith. We have Umesh, who is a part of
Yeah.
WealthCon. We have experts like Dr. Thomas George, Biju John. A lot
No,
of
I
other
want,
people.
I want everybody to, listen to them and take advantage, so that, we are not found wanting, that this is, a lot of people do useless things like, what, Unni has told us not to do. So in case we can repeat all this. And first request is that let's start from the Kochi conference, and let's from the AIOS side get one mailer to all them, give them this website address that they can join, so that majority, or at least even if 10-20% they become, aware of all these things, it will be better for us.
Sir, it is not a should, it is a must.
Hey, thank you. And thank you. I'll take leave, and thank you so much.
Yeah, thank you, sir. Thank you, sir,
Thank you,
for joining us. So we'll just continue the discussion. So, like, Dr. Ranjith, you touched upon two other very important. Like, when I put this message in the KSOS group, Dr. Mahadevan, who is one of the
I think we
senior
can
most.
unshare. You can unshare this so that we can see each other better.
Yeah. So Thomas, just wait 5 minutes. So this is like one. He said, "Yeah, I made enough money, but I feel more important is health." So definitely health. You have a health issue, and see, for some reason you need a liver transplant. Then you see about 20-25 lakhs gone from your account. So that is one reason why the health secretary has told no to fellowships and medical conferences. Okay, so that is one aspect. So how much should money worth of health insurance you should have always? And the other one is the term insurance. The term insurance, how much is it? And see, we would like you to hear about the FBS scheme that we have in AOS. Dr. Rajesh Sinha, who is a treasurer of AOS, he's the one who's the force behind FBS, and he has taken it to the real high levels. You can hear, see how low is the joining fee for FBS now, and the benefits that are going to see, we have more than 5,000 members in FBS now. See, we have the IMA PP scheme in Kerala, PP scheme 1, 2, 3, and all. See, probably this is PP scheme. Sorry, social security scheme. So this is something that is probably beating our SS schemes, and so we'll come to that. Before that, we'll finish it in maybe 15 minutes. So what should be the amount that you should have as a health insurance? See, I personally once I had a personal health insurance of about 5 lakhs. Then one period I had fever, which I was not recovering. Then I went to Amrita, got admitted. See, at that time, I increased my health insurance to 25 lakhs. Got so scared. So then, during another program that we did, I realized that there is something called super top up, for which the premium is minimum. So I added another 1 crore, for which the premium is coming to only 5,000, 6,000 per month. So there is something called super top up. So I would like to know from Dr. Ranjith, Umesh, and Thomas George, what should be the minimum health insurance somebody should have, because this program is on retirement. So,
yes, so
health insurance.
I got the question, sir. So number one, this is not for retirement. Health insurance is the day one you start earning, or you are on your own, you need health insurance. So to cut all those confusions, number one, never ever take family plans. Never ever take family plans. Don't take a plan with your wife, kid, all included. It only gives money to the company, not to you. Because say you have 25 lakhs of together family plan. Your whole family ends up in an accident. The maximum you get is 25 lakhs. And say you have you stay in the ventilator for a long time, etc. 25 lakhs just goes like this for one person. So number one, stop all your family plans. You should have only individual plans. You should have a base plan with a super top-up. So a base plan for every doctor should be at least 5 lakhs. At least 5 lakhs and a super top-up of 1 CR. 1 CR. So, and preferably from the same insurer. You can choose your base plan from X company and super top of Y company, but it makes logistically easy to have the base plan and the super top from the same company. And always choose an insurer which has got a good payout right. We all commonly think in terms of Star Health and Oxford. Star Health is one of the people who pay the least. Plus, they got ceilings at everything. Choose a plan which has got no room ceiling, no procedure ceiling, basic plan of 5 lakhs, at least 1 CR of super top-up. The premium will vary depending upon your age. Never take it as a combined plan. Take for you, your wife, your kids separately. Wife, your kids, if less than 80, can be combined with one of you. You used to get up to 25,000 rupees shoot in the earlier insurance scheme. So number one, at least 5 lakhs basic plan. Take a plan with no room cap, no procedure cap, no city-wise cap. Super top-up plan, which at least be of 1 CR. Like Dr. Shin rightly mentioned, for a 40 to 40 years age group person, to have 5 lakhs base plan will cost you around 18,000 rupees. If you add a 1 CR top-up, it'll add another 4,000. So it comes around 20 to 24,000 rupees for 1 CR for you. So health insurance is an expense which you should compulsory have. Number two, for life insurance, don't think about life insurance as an investment. Insurance is not an investment. Insurance is investment. Don't combine both. When you pay your yearly insurance for your car, do you think in terms of any return from the insurance? No. But why do you want to think about it when you pay for your health insurance? So always have term insurance. It should be at least 20 times of your annual income, not annual expenditure. 20 times should be your life insurance. It has to be a term plan. And that you can take from any insurer. That's the only place where LIC is good. Their payout rate is at least 96 to 98%. Take from insurance, which is not a fly-by-night operator. And if you have any health issues, declare it. Declare it. And if you are not happy with your health insurance, you can port it to another company. Don't take a new insurance, port it. Because all the diseases which have got a window period or 2 years of holding period gets transport exactly if you are porting it. If you take a new
not really, Dr. Ranjith. See, I tried, like, see, I have it with Star only. So I somebody said HSB or something is better because even in our hospital the payout is much better with them. So I went to them and they said no sir, for 1 year it's still your whatever pre-existing this thing is there, you won't get benefit for that. See, you can't actually port your pre-existing.
Sir, you can just you tell them to give in writing, sir. I am 100% sure I ported from Star. All my pre-existing got converted. I took it to HDFC Ergo. Whatever they speak.
Yeah, exactly. I went to HDFC Ergo actually.
You ask them to give in writing, they will not give in writing because if you port it, all your PEDs get transferred. There's no waiting in period for that.
Okay,
No,
just ask one question. That
yes, sir.
If you are insured for say something, some amount, like say 10 lakhs or whatever, so can the insurance company give it in writing in the papers that for particular surgeries this much amount is allowed?
Yes, sir. If you take Star, they've got procedure cap, room cap, everything is capped, which is in fine letters. So you might have one. It happened in my hospital. My colleague had a 1 CR policy in Star. He got admitted for a liver surgery into a premium room. They refused payment of nearly 62 lakhs. He got admitted for a long time, saying that your policy permits only 4,000 rupees room. You stayed in 9,000 rupees room. 6,000 he had to pay in pocket every day into all the 60 days he stayed here. Plus all the expenses like lab investigations, etc., which is room linked, did not get paid. That's when we got to know this. So don't take, before you take a health insurance, make sure there is no procedure cap, no room cap, no hidden charges in that. Star is famous for this. They have capped everywhere. So most of us, you got to know it, got ported. So the most common, we don't endorse any companies. If you look at HDFC Ergo, or if you look at Max Bupa, these are companies which don't have any procedure capping, no city-wise capping. So Dr. Rajesh Sinha from Delhi goes to Bombay for X procedure. Star will pay only what X can afford. Whereas if you have it in HDFC Ergo, somebody or Max Bupa, there is no city-wise cap. So all these things are in fine print, which we will not know unless we face it.
Okay.
Actually, we have to work on the payment to doctors as well, which we will be working very shortly on this. That the doctors are not paid for the amount for which it
is billed. They are billed.
Yeah.
Yes, sir. So that is they. So these are between the third party and the hospital. So we are all kept in the dark. We will not know exactly what the contract is. It's all in the contract. They will pay only what the contract has been pre-agreed upon. So you might charge X amount of fees. You might not get what you charge. You will get only what they have agreed upon. So which is not in our hands as a consumer. When you are a patient, you have no control over that. And so when your hospital makes a policy, you can make it clarify at that situation, sir.
So like what do you do if you have a family? Two things, like you said port. See, how long should you inform like you're porting with Star Health to HDFC Agro? How long is the notice period?
60 days.
60 days. The other one, if you want to you have a family plan, you want to split it into individual plans. How do you go about it? See, without disturbing whatever has happened, like the porting from this thing, okay. But when you split from a family plan to individual plan, will you be losing the benefits of whatever you had?
No, the primary person who's holding it will not lose the benefit of the pre-existing diseases. The other person might lose.
Okay.
There is ambiguity there. So the primary person will definitely not lose. I myself had that experience. Second, when you choose a super top-up plan, say you have 5 lakhs base 1 CR super top-up, the super top-up will have a 2 years waiting period for PEDs. Right? After 2 years, so the first thing to do is right away start working on it. Just see when your health insurance is getting over. Before that 45-50 days, start the work, because it takes around 1 month for the whole paper. It all happens online. It takes around 1 month for the porting to happen. So by the time you're about to pay the next year's premium, you can go to the next new company. And then another thing is that start your super top-up plan today. Don't wait for the primary thing to be live.
Nearing maturity, like
To be live to take your super top-up.
Yeah.
Take the super top-up today, because the super top-up has got a 2-year waiting period. So you can buy a super top-up without a base plan. So decide which company you're going to port into, buy their super top-up for 1 CR, and then start port your base policy.
Dr. Ranjith, for the benefit of the viewers, a super top-up is like like you have a super top-up of 10 lakhs or this thing. You won't get paid till the expense for 10 lakhs. Beyond that, you get paid, right?
Yes, sir. That's right.
The first 10 lakhs you'll have to pay either from your pocket if you don't have a insurance policy,
or your base policy,
or it will go from your primary base policy. So that is a super top up, and so that is it. And okay, Thomas. Thanks a lot. Dr. Thomas George is one of the leading glaucoma surgeons in India, and he gives advice on investments to whoever who wants to listen to him. He said SIP from the time I first met him. So he's.
I was not aware. Now I'll keep disturbing.
Yeah. So Dr. Ranjith, we will finish it in 3 minutes. So like I would like to you to.
I think Srini, I think Ranjith's battery is very low.
I understand. See, this is a program for ophthalmologists. We have a wonderful program called AO's Family Benefit Scheme. I would like Rajesh to explain it to all the viewers here. See how it goes and where it has reached. What is the how low is the joining fee and all. Rajesh, are you there?
Yeah. Actually, it's a wonderful scheme for all the AIS members, and the joining fee has been reduced very substantially, something like $499 for somebody who's less than 30, and similarly, much less fees than it was earlier. For 40,000, it has been reduced down to 7,999. So something like that has we have achieved, and. Plus, the benefits also have increased. This is the only term insurance wherein we provide the exit scheme as well. Like, because it's basically for the members, by the members, and of the AIS members. So that's why we provide the exit scheme as well. Because if somebody in old age wants some money for his health, they can exit and get a reasonable amount of money. Apart from that, there are many other benefits. We have increased the mortality benefit. Also, now we are soon going to announce it within a couple of days. And there are a lot of members. We have now 5,000 plus members, and we have been able to reduce the yearly premium, as you say, yearly contribution that is required by each members. And many facilities are there. You can just pay online by scanning a QR code without paying any additional surcharge. You can become a member just by a click of mouse in 5 minutes time. So there are many benefits. One can go to the FBS AIS website, and it is a very dynamic scheme wherein we keep modifying it based on the feedback of members, and it is total no profit kind of organization. So all the money that we receive is given to the family members of the deceased FBS member. And there's very little bit of paperwork required for that. We ourselves approach to the family members and get it done. So, I mean, these are the things, and many details can be seen in the FBS website. And that's it, I would say. Because
wonderful work, Rajesh. Like you've really proven, you have actually made FBS really attractive, and for the benefit, you have really proven your worth as an administrator. Congratulations and thanks a lot. And thanks a lot, Dr. Ranjith. See, we could have kept on talking on and on. And as you would realize, Dr. Umesh is an expert on everything. Like this is finance. You ask anything about anything, cataract surgery presentation, whatever you ask him, you get an answer. So Dr. Ranjith, he was my roommate, and so I know Umesh better than anybody else. So, Dr. Ranjith, final words from you, and if you're still there and your battery has not really run off.
No, I have enough time.
Okay.
So I know. Thank you very much, Dr. Srini, Dr. Rajesh, Dr. Umesh, Dr. Litsa is left, and the KSOS for allowing us to participate in the discussion. And very nice of Dr. Srini to think about it. It's high time we all have this in our curriculum. Unfortunately, we probably are not in the position to make that movement. So I request all of you to please spread the message among all your colleagues to join Welcon. We are not asking to be traders or investors or anything. Just know that if you can spend 15 years of your life studying a very complex specialty like eye surgery, why cannot you do something as simple as selecting few mutual funds and few shares, and using if you can use WhatsApp, you can use all these apps, and you can take care of your own personal investments. Why do you want somebody who's not even 12th class pass across the corner come and take your money, which you've worked so hard and working so hard to earn? So the entire idea of Welcon is to empower all of us. Like, you trust yourself to educate you. It's you who takes effort to go to any conference, any workshop, and learn something. Spends just few hours of your life into this and become Atmanirbhar, so that we don't have courts and managers and bosses telling us, if you don't do this, you will lose your job, or I'll not get this patient. So that stage has to come. There's space for all of us. God who has created us has God given space for all of us. Kisi ko thoda kam, kisi ko thoda zyada. Lekin, all in all, it doesn't make any great differences. We should not be at the mercy of a hospital manager or a CEO to dictate whom we operate, whom we don't operate, because the love or the need for money should go over from us. And most important is to become Atmanirbhar. If you can have basic investments, you will become financially free. Most of us realize in our 40s. There are guys over hearing it who's in their 30s. So start early, compulsorily make sure that you do set up some SIPs. You can, if you in Welcon, there are 20,000 people on Telegram to help you any point of time, day and night. Thankfully, there are people from different time zones. The people to help you, take you, handhold you through all these things. The platform is unimaginable. The amount of friendship we have got, helping, doctors basically, or we all have got our own individual egos, which gets melted when it comes to money, when it know that together we can go far. Thank you very much, Dr. Srini.
Thank you.
Thanks a lot. Thanks a lot, Dr. Ranjith. Thank you, Rajesh. Thank you, Umesh. Thomas George has left, but he had a significant contribution here. So let's end this meeting here, and we will have follow-up programs on this, because it's such a short time to discuss everything. So thanks a lot, Welcon. Thanks a lot, Dr. Ranjith. Thanks a lot, Natasha, who introduced, and thanks a lot, Umesh, who introduced me to Welcon. So we'll end this program here. Ankit,